Welcome to The Explainer. Let's get right into it. Today, we're zeroing in on the financial outlook and analyst consensus for USA Rare Earth, trading under the ticker symbol USAR. We're going to break down the hard numbers, the massive macro tailwinds, and the very real risks surrounding this incredibly volatile stock. If you want to understand the stakes of the domestic critical minerals race, you're definitely in the right place. And that brings us to the core question we're looking at today. Can a pre-revenue mining company truly become America's next critical materials giant? It has been a wild ride for USR investors, to say the least. Since its SPAC IPO, the stock is actually down about 16%. But over just the last 3 months, it staged a massive 60% rally. The market is clearly trying to figure out how to price a company that isn't making money yet, but is aiming for an absolute mammoth future. Okay, here's our quick roadmap for the briefing. We're going to cover the macro opportunity, their operations and milestones, the tricky situation with government funding and political risk, projected revenue, and finally, the analyst consensus. Starting off with Section 1, the macro opportunity and the race to secure a domestic supply chain. Make no mistake, there are some massive geopolitical tailwinds pushing USR forward right now. Currently, the U.S. relies heavily on China for rare earth minerals, which creates a huge national security and economic vulnerability. To counter this, recent Trump administration executive orders are actively aiming to expedite permitting and literally guarantee base levels of pricing for domestic producers. This political backdrop is essentially handing USR a once-in-a-generation chance to be a massive market winner by closing that critical supply gap. Moving right along to Section 2, operations and milestones. Let's look at their actual mine-to-magnet solution. What's really fascinating here is the sheer scale of the physical asset we're talking about. This is the Round Top Mountain project out in West Texas, which anchors a jaw-dropping $1.4 billion capital investment. Why is this specific mountain so important? Because it boasts a massive 72% heavy rare earth element basket. We're talking about the exact scarce materials desperately needed for defense and high-tech applications. And the state of Texas definitely recognizes this, having just recently awarded the company a $14.2 million grant from the Texas Semiconductor Innovation Fund to really accelerate development. But USR isn't just about digging things out of the ground. They're trying to build out the entire value chain. They are aggressively assembling a global puzzle. They've moved to acquire processing leaders like Crestor and the Serra Verde Group. They're heavily leveraging their LCM UK subsidiary, which is actually one of the world's few rare earth metal producers operating outside of China. Plus, they've brought on global heavyweights, Fluor and WSP, as engineering partners to execute the build-out, all while creating 260 new jobs right there in West Texas. So how does this timeline actually shake out? For a pre-revenue company, timing is absolutely everything. In Q1 of 2026, they expect to commission their magnet facility over in Oklahoma. By Q3 of 2026, their hydrometallurgical demo plant is targeted for operation. But the true moment of truth, commercial scale production of heavy rare earth oxides at Round Top, is targeted for late 2028. That late 2028 mark is the critical horizon investors really need to keep in mind. Which brings us to Section 3, government funding and political risk. This is arguably the biggest catalyst, and honestly, the biggest threat to that timeline. On the funding side, we're looking at a historic proposed government intervention. The Department of Commerce has issued a non-binding letter of intent for a staggering $1.577 billion funding package under the CHIPS Act. That is a $277 million grant paired with a $1.3 billion loan, all in exchange for a significant government equity stake. The plan is to pair this with a $1.5 billion private capital raise to completely fund their operations. However, that proposed funding has triggered some intense political scrutiny. The House Committee on Science, Space, and Technology fired off a fairly scathing letter to Commerce Secretary Howard Lutnick. To quote them directly, they stated, "This USAR agreement creates conflicts of interest, blurs the line between your official responsibilities and your family interests." We really need to impartially outline these specific political allegations because they represent a major execution risk for the stop. The House Committee has literally called for Secretary Lutnick's resignation, citing claims about his relationship with Jeffrey Epstein. Furthermore, they are aggressively questioning that $1.5 billion private placement. Why? Because the lead placement agent is Cantor Fitzgerald, a firm formerly controlled by Secretary Lutnick and currently controlled by his sons. The committee is also warning broadly about the dangers of government overreach and taking equity stakes in private companies. Regardless of where you sit politically, this friction is a critical risk factor you have to weigh when evaluating USAR's ability to actually secure this capital. All right, setting the politics aside for a moment, let's pivot to Section 4, projected revenue and growth. If they can secure the funding and nail the timeline, what does it mean for the bottom line? $2.6 billion. That is management's incredibly bold projection for annual revenues by the year 2030, alongside an estimated $1.2 billion in EBITDA. It's a staggering figure, but it really highlights the absolute size of the critical minerals total addressable market. Looking a little closer to today, Wall Street Zen aggregates some truly explosive consensus revenue growth estimates as the company ramps up. Analysts forecast revenue going from $80.2 million in a year, jumping to nearly $492 million in year 2, and blasting up to $1.5 billion by year 3. The percentage growth rates here are literally in the thousands. It perfectly reflects the transition from a pre-revenue development phase into active, scaled commercialization. Now, tracking right alongside that is the earnings per share, or EPS, trajectory. Because they're spending so heavily to build mines and manufacturing plants, analysts fully expect short-term losses. We're looking at an estimated 55-cent loss per share in 2026, narrowing a bit to a 40-cent loss in 2027. But then, 2028 is the projected inflection point to profitability, flipping to a positive 20 cents per share. Once again, 2028 is the magic year to watch. Finally, let's wrap things up with Section 5, Analyst Consensus and Outlook. How is Wall Street synthesizing all this macro potential against the political and operational risks? The bottom line is that Wall Street is remaining overwhelmingly optimistic. According to Wall Street Zen's panel of 5 analysts, 60% rate USNR a strong buy, and the remaining 40% rate it a buy. Notice what's missing? Yep, there are absolutely 0 holds and 0 sells among this group. Furthermore, that crazy bullish sentiment translates to a consensus one-year price target of $35.20. With the current price hovering around $24.64, analysts are essentially projecting nearly a 43% upside over the next 12 months alone. To provide some grounded perspective, let's look at a really interesting comparison highlighted by Zacks Investment Research, pitting USR against an established competitor, MP Materials. Zacks notes that USR has this incredibly ambitious, vertically integrated vision with immense long-term upside, but it carries super high execution and political risk since it's still in development. MP Materials, on the other hand, is already producing revenues from its established Mountain Pass mine and has a much clearer path to near-term profitability. Zacks actually prefers MP for the near term, highlighting that investing in USR requires a serious stomach for higher risk in exchange for that potential higher reward. Which leaves us with one final provocative question for you to chew on. Do the massive $35.20 price target upside and those undeniable domestic supply chain tailwinds actually outweigh the steep execution hurdles and very real political risks? It's the classic high-risk, high-reward scenario playing out right on the frontier of American manufacturing. That's all for this explainer. Thanks so much for diving into the numbers with us, and we'll catch you next time.